2025. Nitin Raheja, the Executive Director, Head Discretionary Equities, Julius Baer Wealth Advisors, is joining us on the show right now. Nitin, hi. Season's greetings to you. Hope 2025 is bigger, better, brighter for you as well as the markets. But is that the base case scenario? Because last year we saw gains of almost 9% on Nifty, but it was the small cap and mid cap indices which were up over 20-25%. Is it going to be another year where small caps and mid caps outperform massively, or do you think there's room for large caps to catch up?
Firstly, a very happy new year to you and all your viewers. So I think what you've sort of highlighted is correct. I mean, last year was a pretty much of an anomalous year where the large caps underperformed dramatically, while the mid and small caps actually gave almost a 70-80% outperformance vis-a-vis the large caps. And I think that has largely got to do with the fact that you have huge FPI flows that have been taking place. I think we had the single largest FPI flows in a year, but it's sort of a testimony to our markets that despite this kind of flows, we held up and we yet, ended up, delivering positive returns. And it was, around 10% for the large and 17-18% for the mid and small. And, I think broadly this year is going to be equally challenging. At least the first half of the year is going to be pretty challenging. Because we have a earnings slowdown that we are seeing, which we saw in Q2. I think Q3 will be better, considering that we had all the festivals in that period. So whether it was Diwali, Christmas, and so on and so forth. But Q3 is going to be better. But I think the earnings slowdown is probably going to take a couple of quarters to wear out. I think what has really happened is there has been this little bit of a change that we have seen. A lot of our growth was being led by capex, and it was primarily government capex. Being an election year, we saw a marginal slowdown in capex take place, and that has not yet come back fully in terms of what was budgeted in the last budget in July. We should start seeing that starting to happen over the next 2 or 3 months. So you should see a bunching up of orders take place in the next quarter. So hence, as we get into the next calendar year, I think towards the second half, we will see the impact of all of this on the ground. But the other interesting thing has been consumption, which has been persistently, defying expectations and has been slow for some time. We saw premium consumption doing very well in the first half of the year, and even that seemed to slow down. But I think, this whole move that governments have seen of trying to give handouts and there's more of social spending happening with each election in mind has yielded results. And if you look at it from the other perspective, clearly the consumer is hurting. And when he is getting this handout coming, he's sort of rewarding the incumbent who's giving him that handout by electing him to power. But I think that money which is flowing into individual consumption hands should start seeing consumption also come back as money, on a monthly basis, money is going into the hands of, say, the women in the family and so on and so forth. So we should see the bottom end of the consumption curve starting to show signs of revival. But I think a lot of this in this year is going to be back-ended. We are going to start seeing those signs from the second quarter of this calendar. And then, depending on how we see monsoons. So, but this year, if you ask me, is going to be an equally challenging year. The trend of the last 3 months, where the markets have corrected almost 10% for the large and the mid-cap space, is possibly going to be the trend that we're going to see in the near term. So, in the short term, I believe we are in a time/price correction where markets will probably trade within a range of 2,000 points. Make no mistake, we are in a long-term bull market, but it's a bull market which is on a short-term pause.
Hi, this is Shrishti also joining in. Great to have your views on the Indian markets, but I just wanted to dig deep a little bit on the consumption, the point related to the consumption that you were making, that you believe that the bottom end should start showing some signs of recovery and probably in the second half, the cheer should be back. But one such theme that has played very well within the consumption space is the discretionary spending. So given the kind of run-up that we have seen in this particular year, what's your outlook outlook for the discretionary spending? Is that the trend that is expected to continue and do better?
Look, when you talk about discretionary spending, you need to break it up into two baskets, right? So we've had this K-shaped recovery post-COVID. So the top K, which looks at, so what I would call it as premium discretionary spending, has done very well, right? So whether it's in the form of real estate sales, or whether it was in the form of premium automobiles, and so on and so forth, or travel for that matter, has done very well. Now, it's the bottom K which has struggled. I think the bottom K has struggled primarily because wages have not grown at the same pace as inflation has. And inflation continues to remain persistent. And hence, you have seen this big dissatisfaction. And I believe, with almost an amount close to 2.1 trillion rupees being handed out, by state governments in the form of, social spending or doles, if you were to call it. I think that money coming into private hands is going to help that bottom end of that, consumption curve sort of revive as we go ahead over the next, few quarters. As far as the top end is concerned, I think we are, even if you go by the current December quarter, we've seen travel being very robust. If you go anecdotally and check out hotel ARRs or flights and so on and so forth, we've seen that continue to remain robust. I think the festival season has gone up well when we talk to a few of the retailers and so on and so forth. So I think that that is not the concern. That segment is less affected by inflation as vis-a-vis the bottom K, and that's where we see the recovery happen over the next few quarters.
Nitin, quickly, because we have a bit of a paucity of time, if you had to list out the top 2 or 3 sectors for the year, where would you place your money?
So I think clearly, we think private banks, especially financials, should do well because we see capex starting to fall in place. We've already seen a number of approvals come in place. We see government capex coming back. We see private capex fall back. So I think we do see banks doing well. And if we do get the rate cut, that actually works very well for private banks. So I think from that cycle perspective, it would work out well. So financials is one sector. The capex sectors such as power, railway engineering companies should do very well. We see telecom being a growth sector, and with one of the large incumbents announcing their IPO at valuations, we clearly see there is a pressure that we do see ARPUs increasing. So we see telecom doing very well, and autos also continuing to do well.
Nitin, great to have you on the show, and also good to know the themes that you're working on and your view on the markets. Thank you so much for taking the time out and speaking with us.